The banks just crushed the paper price again. They pushed silver back under 62 and told you the move was over. They want you to believe this was a speculative blow-off, a bubble that popped, a chart that failed. That story is a lie, not a small lie. A lie of a mission so large it hides the most important industrial shift of this decade. While you were watching COMEX contracts get dumped in New York, while algorithms were triggering stop losses and financial media recycled the same tired narratives, something happened thousands of miles away that made the price of silver temporarily irrelevant. In South Korea, Samsung quietly finalized specifications for its next-generation solid-state production line. The headlines focused on range, charging speed, safety, 9-minute charging, 900 miles, the usual buzzwords. But they missed the one detail that actually matters. The ingredient that changes everything isn't lithium. It isn't nickel. It isn't cobalt. It's silver. Not as a coating, not as a trace additive, as a structural component. Here's the part nobody realized. Samsung didn't announce a battery breakthrough. They locked in a new silver dependency across the global energy system. Think about that for a moment. For decades, engineers tried to design around silver. It was too expensive, too scarce, too difficult to scale. They failed. At extreme energy densities, resistance becomes the enemy. Heat becomes the enemy. Degradation becomes the enemy. And silver is the only material that consistently solves all three. Samsung's new architecture uses silver carbon composite nodes and high-purity silver conductors to stabilize charge flow, reduce thermal runaway, and extend cycle life, especially under fast charge conditions where electrons cannot hesitate without catastrophic loss. This isn't marketing language, it's chemistry. And once that chemistry works, it spreads. This is how technological lock-ins form. The first company absorbs the research cost, the second validates it, the third is forced to adopt it or disappear. By the time the market notices, demand is already spoken for. According to Samsung SDI materials disclosures and supplier documentation, silver intensity per unit in this architecture rises sharply compared to conventional lithium-ion systems, not incrementally, but structurally, because the metal is embedded at critical conduction points that cannot be substituted without breaking performance thresholds. Multiply that by electric vehicle scale, then by grid-level storage, then by aerospace and defense. Now do the math. No one wants to publish. Global silver mine supply sits near 820 million ounces per year. That number has not grown meaningfully in over a decade. Most silver is mined as a byproduct of copper, lead, and zinc, which means higher prices do not automatically produce more supply. Think about that for a moment. At the same time, industrial demand already consumes more than half of annual production. Solar photovoltaics, medical applications, electronics, defense systems. Samsung didn't add demand. They compressed future demand into the present. This already happened before. In the early 1970s, oil demand didn't explode overnight. What changed was the system built around it. Internal combustion scaled globally, supply chains hardened, and suddenly oil was no longer just a commodity. It was a strategic input that determined geopolitical power. Silver is entering that phase now. The difference is speed. Lithium-ion batteries took decades to dominate because they were constrained by safety limits, degradation curves, and energy density ceilings that engineers learned to manage but never truly escape. Solid state removes those ceilings. It allows higher voltages, higher temperatures, higher throughput, but it also removes optionality. Once a manufacturer designs around silver for stability and efficiency, there is no cheap fallback, no alternative metal waiting in reserve, no graceful downgrade path. Physics doesn't allow it. This is the quiet control narrative. Banks trade contracts. Manufacturers secure atoms. One is reversible, the other is not. You were told silver fell because the rally failed. You were told the story was over. But the truth is colder. The price you are watching is the last artifact of an old system, a paper system built for trading narratives, not for feeding an industrial transition that has already begun. Samsung is not betting on sentiment. They are betting on inevitability. And inevitability does not care about charts. The banks are playing a paper game. Samsung is playing a physics game. Physics always wins. To understand why this turns into a trap, you have to stop thinking in stories and start thinking in quantities. Cold quantities, the kind that don't negotiate. Global silver supply sits near 820 million ounces per year. That number looks large. It isn't. More than 70% of that supply comes as a byproduct of other metals, which means silver production is not driven by silver demand, but by copper, lead, and zinc economics that have nothing to do with batteries. Think about that for a moment. If silver demand doubles, supply does not double. If silver prices triple, mines do not magically appear. Most projects take 10 to 15 years from discovery to production. Assuming permits are granted, capital is available and local opposition does not intervene. This already happened before. In the early 2000s, analysts assumed copper supply would rise with demand. It didn't. Ore grades collapsed, costs exploded, and prices adjusted violently, not because of speculation, but because the math failed. Silver is more fragile than copper. Now layer in the new demand vector. A conventional internal combustion vehicle uses roughly 1 ounce of silver, mostly wiring, mostly switches, mostly incidental. Solid-state electric vehicles are different. In high-performance solid-state architectures, silver usage moves from peripheral components into the core electrical pathway, where current density, heat tolerance, and conductivity margins determine whether a battery degrades in 5 years or survives 15. At that point, silver stops being optional. Even conservative engineering estimates suggest silver intensity per vehicle rises multiple times compared to traditional designs, not because engineers want it, but because the alternative materials fail under stress. Multiply that by scale, 90 million vehicles per year globally, electric vehicle penetration climbing toward 50% by the late 2020s. Grid-scale storage expanding to stabilize renewable heavy power systems. Military platforms electrifying for efficiency and reliability. Now subtract reality. Silver is already consumed by solar panels at a rate that alarms manufacturers, medical applications that cannot substitute materials, electronics that rely on silver's unmatched conductivity, and defense systems where failure is not tolerated. This is where the trap closes. The demand curve bends upward, the supply curve stays flat, the intersection disappears. Here's the part nobody wants to say out loud. Markets assume substitution. Physics often removes that option. You can replace copper with aluminum. You can replace oil with alternatives, eventually. But there is no replacement for silver at the conductivity threshold solid-state systems require, especially when scaled to millions of units under high stress. This is not theory, it's material science. And once manufacturers commit to this architecture, reversing it is not economical, not politically acceptable, and not competitive. This is how inevitability forms. The International Energy Agency models battery adoption. They model lithium. They model nickel. They model cobalt. They do not model silver honestly, because modeling silver honestly forces uncomfortable conclusions. It forces acknowledgement that electrification targets collide with material constraints long before climate goals are met, and that the transition is not limited by ideology, but by atoms. This is the quiet control narrative. Prices are managed through futures markets. Narratives are curated through selective reporting. Meanwhile, procurement teams lock in long-term contracts quietly, securing what they can before competition notices. This is elite betrayal. The institutions tasked with transparency obscure the bottleneck. The institutions tasked with stability suppress the signal. You weren't supposed to see this yet. This already happened before. In Weimar Germany, money printing masked structural shortages until prices detached from reality. In 2008, mortgage derivatives masked insolvency until liquidity vanished overnight. In both cases, the public watched indicators that were no longer connected to the underlying system. Silver is approaching that point. Paper contracts can be created indefinitely. Physical silver cannot. Think about that for a moment. The COMEX can trade 100 ounces of silver for every ounce that exists. That works until delivery matters. Solid-state batteries make delivery matter. Once automakers require silver, not next year, but this year, not in theory, but in production, the distinction between paper and physical becomes existential. This is the doom mechanism. It is not a crash. It is a squeeze on reality. And squeezes do not resolve gently. They resolve suddenly. The timeline is shorter than most people expect. Solid-state pilot lines are already running. Commercial rollout begins mid-decade. Automotive platforms lock designs years before vehicles hit showrooms. By the time consumers hear about it, the material commitments are already signed. 24 to 36 months. That is the window where perception still lags reality. After that, silver stops being discussed as a trade and starts being discussed as a constraint. And constraints change policy. Governments intervene. Strategic stockpiles are considered. Export controls appear quietly. This is the coming reset. Not a collapse of markets, but a repricing of truth. The price you were shown last week was not a signal of abundance. It was a signal of denial. You were told silver failed. You were told demand was speculative. But the system already moved on without asking permission. Here's the part that matters to you. Once silver is recognized as a strategic energy metal, access becomes more important than price, and ownership becomes more important than timing. That is when optionality disappears. You won't be warned. There won't be a headline saying last chance. There will only be a moment when liquidity vanishes and explanations arrive afterward. This is not fear. It is pattern recognition. This already happened before. And the people who understood the bottleneck early were not emotional. They were quiet. They were patient. They watched the math. And they moved before the rest of the world realized the game had changed. Every system breaks the same way. Not loudly, not all at once. It breaks when constraints replace choices. This is where silver is heading. For most of modern history, silver lived in two worlds: monetary symbolism, industrial utility. That balance kept it misunderstood. But once solid-state architecture forces silver into the core of energy infrastructure, that balance collapses, and silver exits the commodity category entirely. It becomes strategic. This already happened before. In ancient Rome, silver was abundant enough to coin, but scarce enough to anchor trust until military expansion outpaced supply, debasement followed, and the empire quietly admitted it could no longer afford itself. In Weimar Germany, paper promises replaced material limits until bread prices changed faster than wages, and confidence vanished overnight. In 2008, leverage replaced liquidity until margin calls revealed there was no floor beneath the system. In every case, the warning signs were visible. They were ignored, because institutions don't collapse from ignorance. They collapse from incentives. Here's the hidden agenda. Governments want electrification targets met. Corporations want performance advantages locked in. Financial institutions want stability preserved as long as possible. None of those goals tolerate honest discussion of material scarcity. So the narrative stays focused elsewhere. Lithium headlines, nickel shortages, cobalt ethics. Silver stays in the footnotes. But procurement departments don't read headlines. They read specifications. And once those specifications demand silver at scale, the system shifts into allocation mode, where price signals stop functioning normally and access becomes the real currency. Think about that for a moment. When something is cheap and abundant, markets set the price. When something is scarce and essential, power decides who gets it. This is the quiet transition most people miss. By the time strategic metals are discussed openly, contracts are already signed, stockpiles are already spoken for, and the remaining supply is rationed through volatility that looks chaotic but isn't. It's controlled. This is the ticking clock. Solid-state adoption does not need mass consumer awareness. It only needs regulatory approval and manufacturer commitment. Both are already happening. Battery safety standards increasingly favor solid-state designs. Fast charging mandates reward architectures that tolerate heat. Automakers cannot afford to ship inferior platforms while competitors leap ahead. Once one major manufacturer commits fully, the rest follow. Not because they want to, because they must. That is how inevitability works. 24 to 36 months, that is the window before silver is treated differently by policymakers, before export restrictions are discussed quietly, before strategic reserves are reconsidered under new definitions. When that happens, the market you recognize no longer exists. Paper silver continues to trade. Physical silver disappears. This is where the personal stakes emerge. If silver becomes a strategic energy input, access is prioritized for industry, defense, and infrastructure, not for investors, collectors, or speculators. Retail supply tightens. Premiums detach from spot. Liquidity becomes conditional. You don't get a warning email. You simply notice that availability changed, explanations are vague, and the narrative shifts to temporary disruptions that never quite resolve. This already happened before. In 2020, supply chains didn't collapse because factories stopped working. They collapsed because assumptions failed. Silver is approaching that same moment. The system assumes silver demand can be managed. The system assumes substitution is possible. The system assumes futures. Markets reflect reality. All three assumptions break at once. And when they do, repricing is not gradual. It is violent, not because of panic, because of recalibration. Here's the part that closes the loop. You were told silver fell because the rally was over. You were told demand was speculative. You were told nothing fundamental changed. But fundamentals already shifted beneath the surface. Samsung didn't speculate. They engineered, and engineering decisions don't reverse easily. Once silver is baked into energy infrastructure, it doesn't matter what the price was last quarter or what a chart looked like last week. The system needs the metal, and systems always get what they need. The question is who pays the adjustment cost. History answers that clearly. It's never the institutions that hid the problem. It's the people who believe them. Think about that for a moment. The final stage is not collapse. It's normalization, a new price regime, a new access hierarchy, a new understanding of what silver actually is. By the time that understanding becomes common, the opportunity to respond has already passed. This is not a prediction. It's pattern recognition. This already happened before. The banks played a paper game. Samsung played a physics game, and physics does not compromise. The silver bomb wasn't an announcement. It was a lock-in. You weren't supposed to notice it yet. But now you have. And once you see it, you can't unsee it. Every transition ends the same way. Quietly, at first. Then all at once. This is the phase silver is entering now. For years, the market treated silver as something optional, something flexible, something that could be hedged, swapped, papered over, and delayed with derivatives that multiplied supply on screens without ever touching reality. That illusion only survives while the system does not need the metal. Solid state changes that. When a material becomes essential to energy infrastructure, price discovery stops being democratic. It becomes hierarchical. Access replaces affordability. This already happened before. During World War II, copper markets did not collapse. They were bypassed. Allocation replaced pricing. Industry was fed first. Everyone else waited. Silver is approaching that same threshold, not because of war, but because of electrification mandates that function like one. Here's the hidden mechanism most people miss. Futures markets are designed to manage volatility, not scarcity. They smooth perception. They delay recognition, but they cannot create atoms. As physical demand rises, inventories drain quietly. Registered stocks shrink, delivery times extend, premiums detach. At first, it looks temporary. Then it becomes permanent. Think about that for a moment. When premiums rise but spot stays low, it's not a signal of weakness. It's a signal of bifurcation. Paper silver exists in abundance. Physical silver does not. This is the final warning stage. After this, the system adjusts. Banks do not lose control overnight. They retreat. They widen spreads. They settle in cash. They discourage delivery. Not because they are evil, because the math no longer works. This is where the quiet control narrative becomes visible. Officially, nothing breaks. Unofficially, everything changes. You're told markets are functioning. You're told liquidity exists. You're told volatility is normal. But behind the scenes, procurement teams are renegotiating contracts. Governments are reviewing strategic classifications, and manufacturers are calculating how many ounces they can secure before competitors do. This is the ticking clock completing its cycle. 24 to 36 months was not a guess. It was a design window. Battery platforms lock years in advance. Material contracts are signed years in advance. Once those commitments harden, the remaining supply becomes contested. That is when the reset arrives. Not a crash, a redefinition. Silver stops being discussed as an investment. It starts being discussed as an input constraint. And constraints change everything. They change policy, they change trade, they change who gets priority. This is where the personal consequences finalize. If you rely on price signals alone, you will always be late. If you rely on narratives, you will always be wrong, because narratives serve stability, not truth. History is brutal on this point. In Rome, debasement was framed as continuity. In Weimar, printing was framed as necessity. In 2008, leverage was framed as innovation. Each time, the story held until it didn't. Silver story is doing the same thing now. You are told it's volatile. You are told it's speculative. You are told it's cyclical. But none of that matters once it becomes embedded in the machinery of the future. Samsung understood this. They didn't buy silver as a trade. They engineered around it. That single decision changes everything downstream. Because once one global manufacturer proves the architecture works, others follow, regulators adapt, standards shift, and demand becomes inelastic. At that point, there is no debate. There is only allocation. This is the final echo. The banks pushed silver under 62 and told you the move was over. They told you the rally failed. They told you nothing changed. But something did. While paper was being sold, physics was being locked in. While charts were breaking down, supply chains were being rewritten. While attention was elsewhere, the future quietly claimed its materials. This already happened before. Those who saw it early didn't panic. They didn't argue. They didn't announce. They simply stopped trusting the surface and started watching the structure. Because structure always wins, the silver bomb was never about price. It was about control. And control, once lost, is never given back.